Okay, problem 11.4a on page 547 is a complete cash flow problem by the indirect method. So let's get started. It's going to take a little while. First thing we do is we go to the income statement and get whatever numbers we can from the income statement. Well, the one number we can get from the income statement is net income, $140,000. The other number we can get from the income statement is depreciation expense, and that's listed there as $37,000. So we know we need to add that back. We're also told that there's a loss on the sale of land. So that's $9,000 that we have to add back here. But I would recommend that you immediately come on over here and make a note that you had a $9,000 loss. Okay? It's just easier to do it right away so you don't forget about it. It's just, there's so much stuff here that it's easy to forget about some pieces, and we just don't want to do that. So I always find that it's easier to do them piece by piece and as I go along. That way I can't forget. And I know you're young and you remember everything, but you're going to get old like me someday, and it's just easier to do it this way. That way you can't possibly forget. Now we're done with the income statement because there's really nothing else there that we need. So now we're going to go through the balance sheet. We're going to look at last year and this year and see what happened. Well, last year our accounts receivable was $70,000. This year our accounts receivable was $92,000. So the difference is $22,000. And that's $22,000 up here in net income in sales that we didn't collect cash for. So we need to subtract that because we didn't get that cash yet. Now our inventory last year was $145,000. This year it's $140,000. Our inventory went down by $40,000, and at the risk of sounding condescending, and I'm not, when you sell inventory, what do you get? Cash. So our inventory went down, our cash had to go up. Remember, all of this is based on the change in cash is equal to the change in liabilities plus the change in equities minus the change in non-cash assets. Okay, so it's all based on that dynamic equation, that cash changes directly with the change in liabilities, the change in equities varies directly with those, and varies in the opposite direction, inversely, with the change in non-cash assets. So, prepaid rent is clearly a non-cash asset. If it goes down, cash goes up. Likewise, if it goes up, cash goes down. Prepaid rent went up. Last year our prepaid rent was $7,200. This year it's $14,400. The difference is $7,200. So our prepaid rent went up. So our cash had to go down. It's one of these guys. It goes in the opposite direction. Now, accounts payable. And there the real important word is payable, whether it's accounts payable, interest payable, tax payable, baklava payable, it doesn't matter. All payables work the same way. Payables are these guys. They go in the same direction as cash. So if a payable goes up, cash goes up. If a payable goes down, cash goes down. So accounts payable last year was $91,000. This year it's $75,000. So our accounts payable went down $16,000. So if our accounts payable went down 16,000, our cash had to go down by 16,000. The only way you can make a bill go away is to pay it. So if our accounts payable went down, our cash had to go down with it. Our interest payable also went down. So we know that if our interest payable went down, our cash had to go down. Our interest payable last year was 15,000. This year, our interest payable is, where are we? Last year our interest payable was 12,000. This year our interest payable is 7. Our interest payable went down by 5,000. Our cash went down by 5,000. Then we had our income tax payable, and that's the last line in the liability section of the balance sheet. And our income tax payable was 15,000. It's now 16,000. So liability, it went up by 1,000. Our cash goes up by 1,000. So we sum that column: 140 plus 37 plus 9 minus 22 plus 40 minus 72 minus 16 minus 5 plus 1. When we're done, we find that our net cash from operating is $140,800. So our net income was 104. I'm sorry, I wrote down 140. It's 104. Our net income is 104,000. Please excuse me, I'm a moron. Net income was 104,000. Look, right number, 104,000. Net income, 104,000, but after we made all our adjustments, our total yield was 140,800 in cash. But stand by, sports fans, we're not done yet. We still have the investing and financing section that we have to deal with. And then it tells us that we purchased investment in bonds. An investment in bonds means you're buying bonds of another company. These are not our bonds. If they were our bonds, it would be down here in financing. These are bonds from someone else. We bought $115,000 of bonds from someone else. So that's a use of cash. Our cash went down $15,000. Now, if you look at our land, last year our land was $260. This year our land is $220. That's a difference of $40,000. So we got rid of $40,000 worth of land. We ended up with a $9,000 loss, which means we got $9,000 less than the $41,000. So we got $31,000 for the piece of land. And if you look at item 2 and additional information, that is indeed what they tell us happened. So our cash from investing activities, when you net those two numbers together, is $84,000 negative. 84,000 outflow of cash. Then they tell us we have some financing activities, and let's take a look at our financing activities. Looking through it, we sold no common stock. Okay, the only thing I see for financing is item 4 in additional information. We declared and paid a dividend of $30,000. We paid it, so that's $30,000 out. So let's take a look and put that all together and see what we have. we started with cash at the beginning of the period of $227,800. So cash at the beginning was $227,800. If we add together all three of our cashes, we have 84 and 30 out, so we have minus 114 out, and cash in of 140,800. So that gives us a total change in cash of 26,800. So our net increase, our total, 26,800. And the way I got that was I took the 148,800 cash from operations minus cash from investing, 84. That's from investing activities, minus the cash from financing activities. And when you subtract all of that, you come up with 26,800. That's our total change in cash. So our cash at the beginning of the period was 26,800. Our cash at the end of the period should equal that total. That's 0, 0, 8 and 8 is 16, 7 and 7 is 14, 2 and 2 is 4, plus 1 is 5, 254,600, and that is indeed our ending cash. So we've proofed the cash. So we had looked at the income statement, the balance sheet, and said what happened to cash, up or down, and from investing, from financing, or from operating. Now, we do have one significant non-cash activity, and the problem is not finished until we handle that. And that's in item 3, in additional information. We purchased $70,000 in equipment by borrowing $70,000 with a note payable. So we have to include $70,000 note for equipment. And that explains the difference in the notes payable in the investing section, or financing section, excuse me, and the difference in equipment up in the investing section. So that's a complete cash flow statement by the indirect method. You could also do it by the direct method if you wanted to, just for practice, but I doubt that anyone will.